Hello investors, welcome to Proceemo University. Our mission is to educate folks on how to invest their hard-earned dollars intelligently and with confidence. In this episode of Proceemo U, we're going to start with the fundamental ideology that is value investing. Value investing is not new. Largely considered the father of value investing, Benjamin Graham wrote two books on the subject, the first being Security Analysis in 1934, and then in 1949, Graham published The Intelligent Investor. The Intelligent Investor set a foundation of principles that would enable a movement of investing that would go on to create many millionaires and billionaires, most famously Warren Buffett. Value investing is built on a couple of important principles, the most notable being buying stock in a company when the company is undervalued by the market and holding on to the stock until the price catches up or exceeds its value. In other words, buy low, sell high. Sounds easy, right? It actually is pretty easy. But if it's so easy, why doesn't everyone do it? The answer to this question is quite simple: time. Most folks, when they start investing, want to get rich quick. They want to turn that first $1,000 into $10,000 as fast as possible. I mean, who wouldn't want to 10x their money overnight? The reality is 99.9% of folks are not that lucky, and for the 0.01% that do get that lucky, they had to make a very risky bet, and it probably wasn't their first very risky bet, and that 10-to-1 payout probably breaks them even with all of their other very risky bets. One of the core tenets of value investing is predictability over time. Investing in a stock for a short period of time is far less predictable than investing in a stock for a long period of time. This may seem counterintuitive. It feels very counterintuitive. However, we have over 100 years of data at our fingertips, plus the success of folks like Graham and Buffett that suggest to us that the assertion is true. Here is a really simple example to think about. McDonald's is a powerhouse of a brand. It's been around for 80 years, it's known all over the world, and I think it's safe to say McDonald's is not going anywhere. Now, if the stock price of McDonald's today is $275, which of the following statements do you think is more likely to be true? The stock price of McDonald's will be higher than $300 a week from now. The stock price of McDonald's will be higher than $300 10 years from now. I think most of us would agree the latter is far more likely, and we did not even have to read a financial report to make the assumption. Good companies grow in value over time. How much they grow compared to their current valuation is where analysis comes into play. The data we use for analysis as value investors comes from public filings, specifically these documents: the income statement, the balance sheet, and the cash flow statement. A company's income statement tells us how much revenue they are generating, what their costs are, and what their net earnings are as a result of operations. The balance sheet gives us a snapshot of current assets, current liabilities, and shareholder equity. And finally, the cash flow statement tells us about the company's cash flows with regard to earnings, investments, and cash left for future investments or dividends. With this data and some relatively simple math formulas and ratios, we can deduce how much a company should be worth compared to where the market is actually evaluating a company. For example, if our indicators tell us company A is worth $100 million and the current stock price has the company worth $75 million, then we have a potential valuable stock. Now, it's never this simple. There are quite a few indicators we use to determine what a company should be worth, and sometimes these values conflict with each other, and that's why it is always speculating. However, with a little research and a lot of patience, you can make more investments that earn you many multiples of return versus investments that end up losing money, and in the end, amassing wealth. And I'll leave you with this. If you're looking to get rich quick with highly risky trades and options, and that's your investment strategy, value investing is not for you. If you're looking to slowly generate real lasting wealth, then value investing might just be the solution you've been looking for. In future videos, we'll be doing a deep dive into some of the basic concepts we look at when evaluating a stock. Things like price to earnings ratios, past revenue and earnings growth, implied growth, enterprise value, dividend strength, and much more. Please give us a like and subscribe so you can be sure to check out new installments as they are released. Also be sure to check out our core videos to see the Proceemo stock of the week and our personal analysis of that stock. And if you really want to support the channel, please go to proceemo.com and consider signing up for our service for only $5 a month to do analysis on the stocks you care most about. Thank you, and we'll see you in the next one.